Let's bring in Dipan Mehta then to the conversation. And Dipan, would you like to add to that? Just curious to get in your thoughts on the Hyundai IPO. Yes, a steady response on day one, but we were chatting about this earlier that it actually lacks that zing or that X factor that will really make investors excited when it comes to the prospects on listing. Do you concur?
Good morning, and thank you for having me on your show. I think that it's a good IPO to apply for, and certainly we are advising and we ourselves will be applying in the IPO as a measure of disclosure. But you shouldn't expect kind of a amazing listing what we have seen with other IPOs. It may be a more tepid listing because of its size and because of the sentiment in the auto industry as well. And even post listing, you may have a situation where 2-3 quarters may be quite weak because we are seeing a transient slowdown in the auto sales, and that may impact the profitability of all auto companies, Hyundai included. But on the whole, I think it compares very well with Maruti. It may trade at a slight premium to Maruti also because of its product profile and the kind of distribution expansion opportunity which is there for the company and its superior EV strategy as well. So if you're a long-term investor, 2, 3, 5-year type of a view, and you prefer consumer-oriented stocks, then certainly Hyundai fits that criteria. But as I said, I think it's for the long haul, and one shouldn't expect a quick buck on listing.
Expect a quick buck on listing, but Dipan, what with the movement on Reliance, especially tempered by its earnings? The OTC business clearly did not fire, and I guess that's quite reflective on the way the stock as well has been. It's breached some of the key levels, and technically as well looking quite weak right now.
That's right. I think great company operating under challenging environment. Scale also plays a role over here. But there's really no trigger for you to go and buy Reliance unless they decide how to unlock the businesses which are existing in Reliance Industries. And that can make a 10-15% difference to the pricing. Because if you're going to be just a straightforward IPO where Reliance becomes a holding company, then that's not that great for minority shareholders. And you could see even further correction. Whereas if they split the company, I'm pretty certain that you could expect a 10-15% upside. And the management has been delaying a decision on this aspect, on this strategy. But sooner or later, I think a call has to be taken. And as I said, I think there's no trigger to buy into these companies. Also, retail and Reliance Jio now have reached scale and gradually getting into maturity phase as well. So I'm not sure investors will pay that much of a higher P multiple. So the scope for re-rating also has diminished a little bit.
Stock is only 17% away from its 52-week lows. It hit a 8-month low as of yesterday, and you've seen quite a strong short build up on the stock as well. In fact, the volumes as well were 2x that of its 20-session average. That's Reliance in trade for you. But Kunal, you also sense further weakness on the stock, and do you think it can go back to its 52-week lows?
Well, I think the stock has shown weakness, and it's one of the weakest chart from the Nifty 50 so far because the stock is not just down or below its 200-day moving average, it's below its long-term averages by a margin of now 6%, 5-6% approximately. So that's a steep margin for a stock like Reliance Industries, which carries the second highest weightage on the Nifty 50. So I think in that sense, it's going to have an impact on the index trends, sooner or later. But yes, the charts are showing signs of weakness. The fact that the stock, there was this data point where the stock fell by almost 4% to 5% on a single day. Post that, in the next 7 to 10 days, we generally see the stock getting back into a bounce back. But this time around, that bounce has not happened, and we've seen the stock getting into a shallow range first and then a corrective phase thereafter. So I believe that also indicates further weakness into the stock. My sense is that this could drag a bit more low from current levels. May not be in the same price trajectory that the stock may fall very sharply, but it's likely that the stock may drag for the next 1 to 2 weeks by a margin of at least another 3 to 5% further.
That's the technical take as well on Reliance Industries. Meantime, Dipan, with the rupee languishing at 84 to the greenback, what's your view on exporters?
Well, I think that it's a mild depreciation in the Indian rupee, and exporters are struggling with demand situation. I mean, see what has come out from TCS and HCL Tech. The street was expecting higher turnover, better demand, but that's not yet come through. And otherwise, also, I think because of election pressures in US key market and overall slowdown in Europe and the rest of the world, exports really haven't picked up in volume terms. So a mild depreciation will just about ease the margin. provide some flexibility to offer some discounts. But the depreciation of the Indian rupee is not a trigger to buy into export-oriented stocks.
Dipan, I want you to address what's going on with Avenue Supermarts, because that, it seems like there is a structural challenge over there. The management has themselves, alluded to the fact and said that, it is QCOM which is eating into their business, at least in the major metro cities. And look at the innovation which is happening in quick commerce. Blinkit last evening said that they're now going to introduce easy returns as well in some of the large metros. So, you order something and that request of return also can be processed in about 10 minutes.
Yeah, well, that's a very high degree of innovation. And if Blinkit is able to successfully do it, then that's great news for Zomato shareholders like us. But let's see how it actually rolls out. There are a lot of execution issues in something like this. Choice also is a matter. But coming to Avenue Supermarket, yes, I think online sales, quick commerce are eating into the incremental volume growth, especially from stores which are in the urban areas and the metro cities, and that trend will continue. And valuations also are still on the higher side, so I would just avoid Avenue Supermarket for the time being. And this is happening across the board in many industries where we are seeing a slowdown. Could be structural, could be seasonal, could be cyclical. And that really is the challenge for equity investors, because if you have earnings slowing down, then how are we going to support these high PE multiples?
Dipan Mehta, HCL Tech is not far away from its all-time high. Infosys is not far away from its all-time high. If one looks at the most optimistic scenario for the sector, even assuming that they will grow at 10%, I think is above the most optimistic number. So for a sector which is poised to grow at 7 to 8%, why are these stocks at record high?
Yeah, well, I don't have an answer to that, Nikunj. And that is true for so many other businesses where growth is 10, 12, 15% or so, and they are trading at 50, 60 P multiple at near about all-time high. I think it's all to do with the magic of money. We are seeing such huge inflows coming into it that fund managers are buying whatever is available. And whatever is even slightly cheap compared to rest of the market, like IT banks, those also are being bid up. So we are living in a situation where there's a huge flow of money, and almost 2 lakh crores is with the cash with the mutual funds, as I understand. So there's hardly any selling pressure, and whenever fresh inflows are coming into large cap mutual funds, they're all going towards the same stocks, the Infosys and the TCSs and the HDFC banks, and they're keeping these afloat. And clearly, I think, the numbers need to improve for us to sustain these kind of PE multiples. Otherwise, I think we're in for correction. Could be time-wise, could be price-wise. One doesn't really know.
Dipan, so are we in for that phase of the market where downside is little, upside is little? It's just going to be one of those very dull, boring, like this in Bombay time pass market?
Well, that also is the outcome, definitely, Nikunj. One can't really say. But I'm keeping an eye on the earnings, and whatever I'm seeing, I'm not happy about it. I mean, take a high growth company like KEI Industries, it's had a phenomenal track record and present in all the key segments of the cable industry. It's present in extra high voltage cables. It has got certain competitive advantages, and yet the net profit has grown just by 10%, and stock is trading at 67 times. So if something like this is going to be repeated time and again with high PE, high growth stocks, then you need to be a bit careful. I mean, look at the aviation traffic also. That's just about 5% for the industry in September, and the utilization is 86%, which means seats are still available. Look at the way the auto industry is shaping up with such huge inventories taking place over there. Cement, steel, you go industry by industry, and you are finding a lot of challenges over there. And at the same time, the flow of paper keeps on coming, and now the government also started with the Kochi refineries. If they open the tap, then the supply could be immense for all the PSUs. So I'm not getting a comfortable feeling, and I have been bearish for some time, but I have been proved wrong. But I still feel that investors need to create a strategic cash wall.
One is being bearish. One is assuming that accepting that next 2-3 months, maybe a quarter or so, the markets would do nothing, which is that you don't do anything large in terms of leverage, or you don't sell. So are you bearish, or you are expecting that markets will do nothing in terms of price action? Dipan?
See, Nikunj, it's a difficult question to answer because one doesn't really know how much money is there to invest, and all the bad news has been bought into very, very strongly. I mean, one thought that the election results could be kind of change the trend for the market. That did not. Then the budget came and the budget correction also was bought into very heavily. Now we have a slowdown in earnings. It was evident in June quarter. It will become even more evident in September quarter. But if this money, which is structural in nature, which is like a long-term change taking place, if it keeps on coming, then you have to factor in that there could be a sideways market and not a correction, because every correction, be it caused by earnings slowdown or any geopolitical factor or any any other political development or economic development, investors will just keep on buying. SIPs will keep on continuing and new NFOs of the mutual fund will still keep on getting a great response. So it's a very difficult situation to analyze. But when you look at the whole picture, one cannot be too extremely optimistic and factor in a 15-20% type of upside in stock prices and go ahead and buy high PE stocks hoping that they will deliver returns from these levels as well. So this is time to be a bit cautious. I suspect next 3-4 months will separate the boys from the men.
There is one data point which I think is worth bringing out again and again, which is that while we are talking about this FI selling, the intensity of FI selling, which had run into about a $2 billion, $1.5 billion on a daily basis, that seems to be coming down. So what was like a 10,000 crore number has become a 1,500 crore number. And 1,500 crore number was there for the better part of 2023 and 24 initially, for a long period of time. FIs have not been great buyers in 23 and 24. So that is something which markets can easily digest, which means at the liquidity level, DII, retail, NPS, IRDA, PFRD, everything put together, that number is not bad at all, one. Second, in terms of the FI selling, and this is interesting data, our researchers looked at some data, fantastic data. So we may get worried, a lot of folks are telling me, oh, this number is higher than what we saw when COVID happened. But you have to look at the number in context of the market cap. The market cap that time was 2 trillion. Now the market cap is 4 trillion. So in context of the market cap, it's not a very large sell number. So FI selling could be tactical, it could be China, it could be positioning change, but it's not like a dam has broken and every day they would be selling. The intensity has reduced. B, it is less and much less than what they've sold in terms of percentage of market cap. And Indian markets can easily digest 1,000-1,500 crore of net FI sell number from foreign institutional investors only by the SIP flows. I'm not even accounting for insurance, LIC, NPS, what PFRDA would do. So then that just comes back to that original point, which is that, guys, liquidity is back. 1,000-1,500 crore Dipan markets can easily digest.
No, Nikunj, but in your entire calculation, you haven't accounted for the new paper which is coming in, I mean, QIPs are happening, IPOs are happening. Now the government wants to do a, secondary market sale. So you have to account for the fact that there is a lot of paper coming in. And, although FI selling may have come down a little bit, but then there's fresh paper coming in. Promoter selling also remains pretty high. These things also need to be accounted for. As I said, liquidity is a very funny thing to analyze. It's not like, earnings or P multiple. There's no direct science. There's no precedence. And in a country like India, which is so complicated, one really cannot understand how much money is left to invest. So I think till the sentiment remains high, till people's intention to invest in equity directly or through mutual funds remains high, till the excitement around stocks remains high, I don't think that you can see a serious correction. Sideways movement is possible. But keep an eye out, when investors start to feel that, no, this is not going to be a great return story for them. And when the sentiment at the retail level starts to turn, you may have a problem at your hand. And as I said, we are in kind of uncharted territories. I've been watching markets for 30, 40 years, but this kind of a liquidity coming in from tier 2, tier 3, so many SIPs opening up, so many demat accounts opening up, mutual funds taking in so much of fresh funds coming in. This is completely new and one doesn't really know how this will actually end.
Dipan, Dipan, meantime, what's the outlook on a PVR Inox? They posted a loss of about 12 odd crores, but brokerages seem to suggest that the next quarter will look sequentially stronger. We've got a healthy movie pipeline as well. Should investors still pin hopes on PVR Inox, or has the OTT competition really roughened things up?
I'll go with the latter. The OTT competition has completely damaged the business model of PVR. I remember the last time I went to see a movie as well. And when I see around, the younger generation is not also going to the theaters. And it's going to be a very challenging business. And it's like a vicious cycle because theatrical revenues are not looking up. The big banner film production companies are avoiding large, big budget films, which people go to the theaters to watch. So it's like a vicious cycle. And let's face it, the entire entertainment habits have changed. It's more and more on OTT, watching on your mobile phone or on your tablet. And I don't think that PVR Inox are going to be sustainable at these levels. They may start downsizing also soon, who knows. So I'm completely avoiding PVR Inox at this point of time. And you may have a good quarter, no doubt, because of 2, 3 good releases coming together. But look, 3-year, 5-year, 10-year trajectory, big question mark over there.
Dipan, what is there in your portfolio which you would say is a classic turnaround or a classic market share theme? Typically, when you buy stocks, I'll introduce the concept of Dipan, is that you will buy stock for 3 to 5 years, companies which are at an inflection point in terms of either operating leverage or market share gain or some technology breakout. What fits in this Dipan Mehta criteria, which I just outlined? Am I right in outlining your criteria? First, let's talk about it.
No, that's fine, Nikunj. But right now I think that a lot of stories have been pretty well discovered. And there's nothing which you feel is available at a reasonable valuation where there could be a breakout story or significantly higher revenue going forward, which have not been captured in the market. So, I mean, existing holdings are just there the way they are. I was quite pleased with Tata Elxsi's numbers. And once they have sorted out the slowdown in the healthcare side, where they have got some new contracts, I'm pretty certain the overall growth rates will improve and will go back to that mid-teens type of top line, bottom line. It is expensive, but at least there is some amount of growth coming in. And that's important for me. Having said that, it's a measure of disclosure. We and our clients are invested. Also, I think disappointed with Bajaj Finance, the stock price, not the actual performance which is coming through. So, the P multiple over there, the price to book keeps on getting narrower and keeps on shrinking. At some point of time, I think we expect a turnaround over there. And strategically and tactically, I think one needs to get overweight on the banks, although we already are quite overweight. But in portfolios where banks are not adequately weighted, like beyond 20-25% banks, NBFC, I think they should look at getting overweight banks. Because we are seeing, at least on the screen, that there is a certain change taking place over there. Stock prices have stopped falling. Numbers will be decent. I mean, not extraordinarily great, but decent. And there's definitely a re-rating scope over here. And a company like Bandhan Bank came with very good set of pre-quarter releases. Impressed with IDFC First Bank, also both companies in which we and our clients are invested in. So you could see nice pockets of outperformance within the banking space. As a measure of strategically placing your portfolio and maybe even a kind of a trading opportunity.
Dipan, the general view is that capex is going easy, whether it is government or private. So are we in for a significant amount of derating, let's say, in this entire machinery stroke capital goods space? I mean, these are stocks which are trading at P multiples which are 50, 60, 70, 80, even 100 times.
Yeah, you're right. I think there's a cyclical upswing, but the bigger problem over here is, the base effect. Right until about a year and a half, 2 years ago, they were coming up from a very low base. Now, when the results we declared for FY25 and FY26, they're working on a very high base. And these are physical businesses. There are execution challenges as well. Even if you have an order book position, implementation is a challenge. And a lot of the positives have got factored in. But the order inflows are improving, as we are seeing, especially for the EPC and the construction companies, and that may support these kind of valuations. But it's not that it is an undiscovered sector, and you could see a significant outperformance. I think the order inflows need to be sustained at these levels for investors to at least maintain interest in these companies, and for these companies to remain to be traded at these price to earnings multiple.
Viresh, defense stocks, railway stocks, we would discuss them at length. We would discuss them as every second question. Now we hardly discuss them. Where are they headed? I mean, they were the talk of the town. Now most of the defense and railway stocks have corrected 25 to 40%. Are they getting ready for a quick bounce back trade as the year unwinds?
So overall, there's a possibility of a bounce back across the board because they've corrected quite a lot. Say, for example, Hindustan Aeronautics has still not broken the 4th June election lows. Majority of them have not come to those prices. But this is a tough bounce back because a bounce back, say, if you go from 100 to 70 on a stock or 65, it may go to 75, 78 and then again pull back. So a tough bounce, I would not be interested in playing that. Rather, if one has higher allocations to this sector on the rise, one should be looking to reduce rather than buying this bounce. I think after such a fall of 30%, we tend to get into a 6 to 18 months of sideways consolidation, wherein the previous highs don't cross. And this we've seen time and again happen with a lot of stocks. So there was a time when Tata Power, etc., these names became very well known and very when they moved almost 3-4x, and then it went to a 12 to 18 months period of no returns. I think we are getting into that phase. So one is better off looking to reduce than to buy the bounce.
Okay. Meantime, let's also get in a take from you on what the outlook is, Kunal, before we get to those mid-cap calls on real estate counters. A lot of these companies have been quite aggressive. We have seen momentum on ground picking up. But what about the stocks? What's looking good?
Yeah, I think this is the pocket where there is renewed vigor as well as momentum, because many of these stocks are coming back into a breakout mode. We've seen the likes of Oberoi Realty, Godrej Properties, Soba Developers, etc. Many of the large cap names as well as the mid cap stocks, they've gone through almost like a V-shaped recovery in this last 10 odd days. First a correction, where these stocks corrected by a margin of 5-7%, and then these stocks rallying up higher by a margin of 5-10% further from their previous major swing high. So I think that's an indication of these stocks trying to form a bottom for themselves. I would believe that Oberoi Realty is one of the strongest names so far in this last 1 week of recovery in terms of the prices. Godrej Properties is something which is looking attractive. DLF, the stock has found a major support at the 800-820 odd range. That stock is also, I think, looking attractive at the 850-880 plus mark. So I think these are the three names which I'll be concentrating on.
All right. Thank you so much, Dipan, for joining in and sharing with us your thoughts. It's been an interesting chat.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.
Hyundai Motor India Limited now proposes an initial public offering of its equity shares. The 100% book built offer is being offered at a price band of Rs 1,865 to Rs 1,960 per equity share of face value of Rs 10 each. The anchor investor offer period opens and closes on Monday, October 14th, 2024. Offer opens on Tuesday, October 15th, 2024. Offer closes on Thursday, October 17th, 2024. For risk involved and other details, please refer to the red herring prospectus, which is available on the website of the company, SEBI, VRLMs and the stock exchanges.